This
advisor.
conference will now be recorded.
And in the background, we have Kimberly Stark available for any questions that you want to email into her. And so we'll start off with having her introduce herself and go over some housekeeping items. Kim, are you there?
Yeah, yep, I had to find the unmute button.
There we go. All right, now we'll take Kimberly for housekeeping items.
Well, hi, everybody. I just have a few housekeeping items here. I guess, first of all, I should let you know that I started with Mike back on February 1st. So this is a whole new career for me, but I'm enjoying what I'm doing and meeting some of you already. But we'll go ahead and start with some of the housekeeping items before we get started. First of all, please make sure all your phones and mics are muted during the duration of the call. Please do not put your call on hold. For those of you who have joined via web, please utilize the chat function in the top right corner of your screen. If you have dialed in on your cell phone and are unable to use the chat function, please send emails to myself. I'll be monitoring the emails throughout the call, and that is Kimberly at SaddlePointWM.com. I know a lot of you received emails from me already. And then the last one is, if you have joined via web, please change the view at the top from view who's talking to active cameras. That way you should have a cleaner view of only Rick and Mike. And I think that covers it, doesn't it, Mike?
I think so. Thank you so much for that. In the office, we've gone through a lot of changes as we came over to RFG November of last year, and that has been a tremendous transition, and loving all the new tools that we have. And then to make this work, we've had some recent investment in technology to make the internet and video capabilities possible. Rick is our Chief Investment Officer at RFG, which means that he is in charge of preserving the company's assets. He supervises the team of the qualified professionals that helps develop both short and long-term investment plans. And then he works as, since 2016, building an institutional caliber client-focused investment platform. And then he recognizes that foundations and family offices often enjoy a significantly higher level of access and sophistication around portfolio management. Rick designed an investment program focused on bringing that level of service to you. He works one-on-one with us advisors and for our clients to construct customized portfolios that help meet goals as defined by their definition of success. There is no one-size-fits-all approach. Meeting with Rick, he was one of the reasons having that kind of caliber of access was one of the reasons why we chose RFG for our practice. So Rick, anything I left out there off the notes?
No. We'll just dive in, but I appreciate that. Thank you. It's always nice to get introduced. So that was awesome. Thank you, sir.
Well, wonderful. Well, got a few questions that have come in, and I guess just to kind of keep it casual, what are your overall thoughts on the virus itself since you've been staying plugged in with this?
It's pretty clear here. Let me just rewind the tape a little bit, because I think the narrative of the virus is very important. You initially had this thing sort of found or discovered or whatever it was in China back in, let's say, early March, late February, early March. And the interesting thing about that was, everybody, I think, thought, for rightly or wrongly, for whatever reason, that this virus was contained within China, within the city of Wuhan. And it rapidly became clear as we went through March that probably wasn't the case, right? And that that we saw outbreaks in Iran, we saw outbreaks in South Korea, we saw outbreaks in Italy, that rapidly spread throughout the rest of Europe. And what we're finding out is that it's not actually, and then the United States, which is where we're going to come to next. It was almost as if the virus just popped up everywhere simultaneously at the same time, which is not actually the case, right? What is actually the case is the virus had been here circulating probably since the beginning of February, maybe even January. Just nobody knew it, right? Because we weren't looking for it, we weren't testing for it, we didn't know it was here. And so you had community transmission, in these places like, Washington and Seattle, in New York City, even in our hometown, whatever it might be. You had this sort of virus that's being passed around the community, and people aren't looking for it, and so they just didn't see it. And so we got to a point pretty quickly where the genie's kind of out of the bottle, right? And so the only way to stop a pandemic like this when the genie's out of the bottle, you can't identify who has it or not. You can't put up a wall around the United States because it's already inside. You can't put up a wall around certain states because that has already passed, right? The window to be able to say like, hey, nobody leave New York is also already passed. And so the only way to shut it down is to do exactly what they did, which is to say, all right, everybody just stay in your homes, right? Like stay away from each other. Don't talk to, don't come within 6 feet of each other. Don't go to restaurants. Don't go to movies. Just basic social distancing. And by the way, that's new for us, certainly new for my generation. It's not new in terms of the treatment of overall pandemics. Like if you go back to the Spanish flu pandemic back in 1918, social distancing was a thing, right? And ironically, some cities followed it, some cities didn't. And they quickly found out it was effective because the cities that followed it did better in terms of overall death rates than the cities that didn't. So the good news is that this is something that has been studied before, and we have a playbook for. I think the other piece of good news is, I'll call it as the virus relates to the market, and I'll be very clear on this. As the virus relates to the market, it was really anticipated that, and guys, if you've just arrived, please mute your lines. So there's a little button at the bottom of your screen where you can mute your phones. Anyway, long story short, as we got through the middle of March, it was clear the virus was here. The market sold off dramatically, and I think the data around, okay, look, we've been through a shutdown, just continues to look worse and worse and worse, right? So, if you think about the virus moving through society, there's kind of 4 distinct 2-week phases, right? First, you discover it's here, right? And even if you shut down everything the day that you discover it's here, because it takes 14 days for people to even become symptomatic after they've been exposed, you got a 2-week period where the virus just kind of climbs exponentially, right? And then hopefully, in the second 2-week period, the number of new cases starts to fall off, but deaths actually increase because you're seeing people, once you get sick with the disease, it generally, sadly, takes anywhere from 6 to 14 days to die. So you start to see the death curve is like it lags the overall case count by, let's call it 7 to 14 days, right? So you get 14 days where you've got exponential growth in cases, another 14 days where you continue to get growth in deaths, but cases have leveled off, and then 14 days where cases start to fall and death starts to fall, and then it sort of tails off in phase 4 when you're kind of at the end of both, hopefully, knock on wood. Right. And that's what the models were all projecting for the virus in mid-March. It was like, oh, we just shut this thing down. Peak deaths aren't going to occur until, let's call it, late April, and we're going to be dealing with this thing into May. And that's what all of the sort of theoretical models, projected. And then I think in early April, early to mid-April, we just started to get a lot better news around both the growth rates of the virus being a little bit slower than we thought they were going to be, the death rates from the virus being a little bit lower than we thought they were going to be, And so it enabled this sort of, the rally that you've seen in the marketplace over the past couple of weeks has really been driven in part by great, well, I won't say great, 70,000 people have died. That's not great. But when you were expecting 130,000 people to die, having only 70,000 die is much better than the alternative where we could have been. So now we're in the phase where, a lot of us are continuing social distancing at least through mid-May. Certainly in hot spots like New York and Boston, they're extending that at least through mid-May, maybe even later. But we are seeing certainly declines in the overall number of cases in the United States and declines in the number of deaths per day, which is a great thing. It indicates that what we're doing is working. And it also indicates that we can start to have all of these conversations that a lot of states have been having on, okay, I've seen the light at the tunnel. How do we go about responsibly opening this thing up until we get, either really good treatments for people who have the disease or, a vaccine that's effective, in which case, we can develop herd immunity and this thing becomes much more like a seasonal flu than anything else.
Well, thank you. That's a tremendous recap. So most of the people that are on the line with us are very interested in how this relates to their investments and then the stock market as a whole. So when we're looking at this, have we seen the bottom, or where would the bottom might that be, and where could the top be?
Okay. So I hate questions about bottoms and tops, just so we're clear. But, look, the market in the long run is a weighing machine, right? So the market in the long run does a pretty good job of figuring out the relative value of things. The market in the very short term is a voting machine, right? So you get sellers and buyers in the marketplace, and that's why when you tend to see things where there's a lot of fear or a lot of panic in the marketplace, you tend to see very sharp sell-offs that may not be overly justified. And that's why I shudder to say, oh, we've hit the bottom. In as much as I shudder to say, well, we've hit the top, because you know what, the market itself has the ability to be irrational over short periods of time, right? And I think you've seen that. You can look at Christmas Eve from 2 years ago when the market decided, randomly to be off by 6%, largely because my own personal opinion is because you got a bunch of panicked sellers and not a whole lot of buyers around, because the people who were scared were looking at the market, and the people who weren't were all like off with their families getting ready for Christmas. And so you wind up with illiquidity on both the buying and the selling, a dearth of buyers when you've got sellers, or a dearth of sellers when you got buyers, and that pushes the market one direction or another. So that was a way of saying, hey, don't be too focused on bottoms and tops. What I think is more helpful to be focused on when markets get particularly choppy like this is, what do I see 12 months from now? What do I see 18 months from now? And what does that look like? Because for most of the folks that are on the phone, hopefully they're focused on, hey, retirement's a marathon, not a sprint. I want to think about, where's the value of my portfolio a year from now? Where's the value of my portfolio 5 years from now, 10 years from now, 15 years from now? Not, what is the value of my portfolio on May 30th, right? Or June 1st, right? Like, what's the value at that date? I have no idea. I can tell you right now that let me back up a sec. Long term, there's no question really in anybody's mind that you're gonna find a way to put, Humpty Dumpty back together again, right? Like, there are already, there's already some evidence that some of the drugs out there that are used to treat the disease once you've got it and have a severe case of it are effective at reducing the overall death rate. And if you think about there being a quote unquote shortage of intensive care beds, or a shortage of the equipment necessary to treat the people that have serious forms of disease, if we can shorten the amount of time that those people are in intensive care from, let's say, 14 days to more like 7 days, you've effectively doubled the number of intensive care beds because people don't need them for as long, right? You've doubled the number of ventilators. You've basically created a lot more resources where there weren't any before, which is great, because half the reason why we're doing all of this social distancing and everything else like that is so that we don't have to overwhelm the healthcare system, so that the healthcare system has the capacity to deal with the people that get seriously ill, right? There's also no question in anybody's mind that we will eventually get to a vaccine that is effective for this disease, right? So whether that vaccine is our own antibodies because we get through herd immunity at some point, whether that vaccine is something that's, you know, being developed by, there's 72 different vaccines that are currently under development around the world, and literally anybody who's anybody is working on this. So, you know, there's already actually over in the United Kingdom a phase 2 clinical trial in place right now to go ahead and, you know, test. I think they're testing 6,000 people across the UK. And ironically, based on the success of that drug in phase 1, they're already gearing up production of that vaccine should it demonstrate efficacy, which I'm not going to bore people with. From a medical ethics perspective, testing the vaccine is actually going to be a little bit difficult because you can give it to 6,000 people, but you can't expose those people to the virus like intentionally to see whether or not the vaccine was effective. You just got to kind of let them go out into the universe and hope that, I mean, ironically, you kind of hope that people get exposed to it so that you can see whether or not the vaccine was effective or not. But ethically, you can't be like, all right, like, you know, I've got a control group and here's a vaccine group. And anyway, I digress. If that vaccine passes phase 2 clinical trials, if any of these vaccines pass phase 2 clinical trials, you are out of your mind if you think that there's a health organization on this planet that is going to look at the drug and say, nope, you know what? I think we need to put it through like a 6-month-long phase 3 process, right? If they can demonstrate efficacy in phase 2 and no adverse side effects, it's going straight into production, right? Like there's no health organization in the world that's going to be like, nope, we're just going to let this thing, like we're going to go through normal channels with this because it's not normal times. So there is a light at the end of the tunnel here. And if you think about what the market looks like in 2021, after there's a vaccine, we're all back to normal, we're starting to rebuild the economy, you know, there's a massive amount of federal and fiscal stimulus that is being poured into the economy right now to support the function of the markets, to support people who are unemployed, to make sure that when those people come out of their homes or out of the cycle, that everybody's like, yeah, like I want to go back to a restaurant again. Like I want to go back out and shop and do all of those things that I used to do. And some of that'll change, but like some of it won't, right? Like, you know, a lot of it is just going to be like, I'm dreaming of the day when I can take my wife and kids out to dinner again. So, you know, I think that there's a lot on a forward-looking basis to be positive about. And that's why I think that the market, despite the fact that we're getting atrocious economic data right now, the market's, you know, trading at 2,900 on the S&P 500, not really off that far from where we started the year, because market participants are looking at this and saying, well, geez, if I know that, you know, 12 months from now, we're in a wildly different place, then why wouldn't I, like, I'm not going to sell it down to 2,300 or 2,100 and just say that, yeah, I'm going to have a 30+% return or 50+% return over a 12 or 18 month time frame. Like the market doesn't serve you up that meatball, right? Like that is not something the market's going to do. So, you know, in a weird way, markets are very, very forward looking, and the market right now has said, all right, look, we've beat phase 1 of this disease, or at least we're in the process of beating phase 1 of this disease. Don't know what phase 2 looks like, but do know that we're at least a little bit more on top of this from a testing perspective. And, you know, we're going to get through this thing and we'll see, you know, what's going on the other side of it, which is great. All of that is great.
So as we talk about the stimulus, what about the this being an election year? What are your thoughts on that?
Um, you know, all right. So I'll ask you, like, what are your thoughts on it? Because Michigan, kind of important in this whole thing. So, what's your sense? As I look out at the national polls, each party has problems right now. The Democrats have problems because you can't go out and do the mass style fundraising, the campaign rallies that you would normally be doing right now. It's unclear whether or not they're even going to have a Democratic National Convention unless it is like the world's largest Zoom meeting, right? I don't know what that looks like, but I will tell you that the Democrats need to energize their base. And in particular, Joe Biden needs to energize the Democratic base, because Joe Biden is not the sexiest of Democratic candidates out there, right? Like, it's easy to fire up my liberal friends about Elizabeth Warren and Bernie Sanders. It's not super easy to get them fired up about Papa Joe. So, they need those events to get people excited. On the flip side, the Republican administration's handling of the whole coronavirus thing hasn't been, shall we say, stellar. We were late to the whole party on whether or not the virus was even here or not. Testing has been a fiasco. There's been, I would say, kind of back and forth Twitter statements where, the president will say something, and then, the director of the National Health Institute will sort of walk him back on that. It's one of those things where I think he's catching a lot of flack for it. And generally, depending on when the election cycle is held, if people don't have jobs, if people are out of work, it's the economy, stupid, right? Like, if people are out of work, if people are in pain, and maybe they're not quite as happy with where the economy is going, that speaks ill for the president as well. So I just, both sides have some problems. I would say the Democrats have picked up a little bit in the polls recently. And we'll just have to see what happens come November. But right now, this is less. The market story for 2020 is much less about November and much more about what do we look like on this virus front.
Gotcha. Thank you. Circle back to investments. That's kind of one of the main things that I find myself thinking about here. A lot of the clients that are on the line, when the math has made sense, we've talked about rebalancing portfolios and tax loss harvesting. So would you tell us kind of an overview and kind of maybe educate the people on the call what that is and what its purposes are?
Yeah, absolutely. So, all right, let's start with rebalancing, because I think that's the easiest to understand. When you think about rebalancing a client portfolio, basically, I get this phone call all the time. Okay, so the market's selling off, and it's down 10% or 15% or 20% or whatever it is. And I get the panicked phone call from an investor that says, "Oh my God, the market's down. Things look terrible and scary. Like, now's the time to sell." And the answer to that question is always no. That's when you invest with your emotions. That's a terrible reason to invest, right? Investing because you are scared is not a good idea. Or making an investment decision because you're scared is not a good idea. The second call that I get all the time is, hey, market's up 10, 15, 20%. Like, I'm looking at my statement and this year has been amazing. Things look lovely out there in the marketplace. And by the way, I've got this $50,000 in cash, at the bank or whatever it is. Like, I want to put it in now, and let's just put it all in equities. And the answer is no, that's not a good idea either, right? Like, in reality, what you're investing in there is just the opposite of the fear that you were investing in the other side. You're investing in joy, which is also not a great way to make decisions. So instead, what is smart is to pick what you want your risk tolerance to be, and then use rebalancing math to basically keep you within that risk tolerance. What do I mean by that? All right. So let's say I take an investor, they've got $50 in equities and they've got $50 in fixed income. And we go through the COVID-19 crisis. And so your fixed income bucket stays the same and your equity bucket has dropped by, let's call it, I don't know, let's call it 30%, right? So you're down 30% peak to trough, fixed income's the same. So now, rough math, I've got $35 in equity, and I've got $50 in fixed income, okay? I'm out of balance, right? I used to have an equal amount in both buckets. Now I've got much less in my equity bucket than I do in my fixed income bucket. So we come in and we quote unquote rebalance the portfolio and take about $7.50 and slide it out of your fixed income bucket and into your equity bucket, right? So now I've got $42.50 in both. Why does that matter? Well, when the market rebounds on the other side, and you're up 30%, which is what we've actually seen from the bottom, now all of a sudden I got that 30% gain on $42.50 instead of getting a 30% gain on $35, right? And while that may seem like small change, if instead of $50 I was talking about 50,000 or 500,000, then that return is real dollars. Like it makes a real difference. And by the way, when you get that 30% gain on that 42.50 and you're back up at, you know, whatever it might be, I'm not going to run the math on that because it's complicated, but when you're back up on that, you're going to look at it and say, wow, geez, now I've got too much in my equity bucket, right? I've got too many dollars in my equity bucket. I need to take some of that out of the equities and move it back over into my fixed income bucket to make sure that I'm not taking too much risk based on where the market is, which would help you if there was a theoretical sell-off in the market, right? So if you look at the market right now and you say, geez, we're at 29.50, I don't think that's sustainable. I think the market's come too far too fast. Well, now would be a great time to rebalance your portfolio again, right? To say like, okay, well, equity market's grown a little bit too much. And by the way, for those of you guys who are invested in the steadfast portfolios, you look for that to happen in the reasonably near term because we rebalanced back at 2,300. We're going to rebalance again up here and take advantage of some of the levels that the market's given us now. So that's rebalancing in a nutshell. Tax loss harvesting is a little bit different, and I like to explain this by demonstrating the opposite. Okay, so if I came to you and I said, "Hey, I've got a tax strategy, I've got an investment strategy where every time you get a sizable gain in a position, we're going to sell it," right? You would look at me and be like, "You're insane. That means every time I make money in the stock market, I have to pay realized capital gains on it and just reinvest it elsewhere," right? Like, and that doesn't make any sense. I'm paying taxes when I don't have to. In the same way, every time you have a realizable taxable loss, you should sell the position and recognize the loss. Right? Because you're avoiding paying taxes that you would otherwise have to by not just holding the loss. If you hold the loss unrealized on your investment statements, then you're just missing a deduction on your taxes that you could otherwise have, right? And that loss can be used against your current income up to $3,000 if you need it. That loss can be used to offset distributed capital gains out of mutual funds or anything else like that. And even if you have to roll it over to the next year, well, you'd still rather have it to roll over to the next year than have it just sitting on your investment statements for whatever reason. And so what we do is we look through client statements. We try and figure out where they might have taxable losses that we can realize. We realize those losses. We try and invest the proceeds from the sales in similar securities, not the same security, but similar securities. to kind of maintain that client risk profile, and away we go. But that's the process there and the thought process behind tax loss harvesting.
Awesome. So with the market being cheaper like this, what are some of the ways to take advantage of that?
Yep. So a couple things. What we like to say is I try and avoid, as far as I can, concentrated bets, right? So let's not, if you are particularly enamored with the oil market right now and you're looking at oil at, $10, $12, $13 a barrel, and you're basically saying it can't possibly stay here. You're right. It can't possibly stay there because at that level, almost every major oil producer in the country, actually in the world, other than Saudi Arabia, is unprofitable. But having that thesis to say, okay, look, this isn't sustainable. Oil prices are coming back up, and finding the right investment vehicle to express that view is kind of difficult to do. What do I mean by that? Well, you can choose a small, production company and say, look, these guys have got it figured out and they're going to survive, and they might not, right? Things go bankrupt, particularly in the energy space. You can choose a big old oil and gas producer and they might not survive, depending on how long it takes prices to actually come back and recover. You could buy a futures contract. But we saw what happened with the May futures contract back, last week when prices went negative, which, we shot a little video on, but, in reality, it's just a function of the liquidity of the marketplace. So what we always encourage people to do is look, don't, if you've got a general investment thesis or you like a particular space or whatever that might be, don't go buy a single security, right? Go buy a basket of securities. Get a diversified approach to whatever your thesis might be so that you don't run the risk of
Single company.
So that you don't run the risk of being right on your thesis, but being wrong on whatever investment vehicle it was that you picked to try and invest in it. The other thing that I would say is, the things that we try and do is we try and look for areas of the marketplace where the market may be breaking down in terms of that balance between buyers and sellers. So, earlier in the year, we did a couple of closed-end funds. Back in March, we bought a couple of closed-end funds that were basically trading at discounts to their net asset values. And I won't bother to go through all the mechanics of exactly how and why that can happen. But the reality is that, you're effective. You have the effectiveness of this. There's a guy on a street corner with a $100 bill that really needs change, right? He really needs to break that into singles, right? And you're the only bank in town, and he really needs the change. And so you look at him and be like, all right, well, I'll tell you what, I'll give you 92 singles for that $100 bill, right? You just bought $100 at an 8 or 9% discount. Now, you've got a $100 bill. You don't have all those singles, and that may mean that you can't walk into the gas station next door and buy a bottle of water with it if they don't happen to have change. But assuming that the market plays out eventually, there will be somebody else that is willing to take that $100 bill off your hand for $100. And that's the type of opportunity that you're looking for, is taking advantage of people that are forced sellers of assets or panicked sellers of assets and buying opportunities cheap. And that's what we look for, every day when these types of markets dislocate. It's an old example, but it's a good one. How much is a bottle of water worth? Well, it depends on where you are, right? If you're standing outside a convenience store, it's not worth all that much. If you're in the middle of the Sahara Desert, it's worth a whole lot. So being that provider of liquidity when there's not another buyer is frequently rewarding to folks who are patient and don't give in to the fear.
Very nice. Good analogy. When we're looking at this now too, there's the different distribution rules for a lot of retirement assets this year, like with the RMDs and CARES Act. And I was wondering if you don't mind giving the people on the call a brief overview on that as well.
Yeah, absolutely. The CARES Act basically suspended RMDs for 2020. So you do not need to take the normal RMD that you would take. And it gives you the ability, if you've already taken your RMD, to potentially roll that back in within a 60-day window, and basically you have about 12 months to do that. So I'd encourage you, with respect to that, to reach out to your financial advisor, obviously, to talk about exactly whether or not, if you've already taken it, whether or not you can roll it back in. The only people that I think are getting a little and hopefully the IRS clears this up, but apparently the only people that are a little bit stuck in the window on this would be people who took their RMD in like January, because the look back period doesn't go back that far, so theoretically they couldn't roll it back in. But for everybody else, you don't have to take it. If you need to take it, you can still take it. There's no big deal. But if you would prefer to either not take it or fund your distribution from elsewhere, then you don't have to take it. And you can probably put it back in. My sense is, for most people who were taking RMD distributions in January or February, most of those folks probably actually need the distribution, because otherwise, just from a planning standpoint, you'd rather, if you're forced to take the RMD, you'd rather take it at the end of the year as opposed to the beginning of the year, and let it continue to grow, knock on wood, tax deferred over the course of the year. My sense is that there shouldn't be a lot of people in that first bucket, or sorry, in that bucket of people that maybe can't put it back in, but just be aware. And it's a nice give, because there are a lot of folks that that they're basically trying to make sure that people don't have to sell if they don't need to.
Okay, the questions are slowing down a little bit. I want to remind people that if they do have questions, to go ahead and email those to Kim at Kimberly@SaublePointWM.com. And then, so to circle back to you, Rick, have you ever seen anything like this before? And what are you doing to thrive in this type of environment?
Awesome. So, look, I was around back during the 2008-2009 financial crisis, as well as the 2001 internet bubble, whatever you want to call it. I was really more sorting out the aftermath of the internet bubble. But anyway, long story short. So I was at Bain Capital in 2008, and I was covering consumer and retail, which is not a great place to be. And I can just remember with kind of horror looking at just staring at the Bloomberg and watching the numbers dive, right? And just I remember when Bear Stearns failed. I remember when Lehman failed. I remember AIG. I remember each one of these things, like where I was when we got the news that Lehman Brothers is going under. And the interesting thing is, I'll say two things. One, this crisis is very different than the great financial crisis. It's different in a couple ways. The first is, this is more akin to like a natural disaster that hit everybody at the same time, right? So it's as if a hurricane just hit like every major city in the United States at the same time, knocked us all offline, and we're going to have to spend a couple months like rebuilding the country, right? And that's actually, I kind of like that analogy, because it's going to take a while for everybody to get out there and start to, go back to restaurants again, restart that cycle, and do everything like that we're going to need to do. But we'll get it done. If I go back to the great financial crisis, there's an issue in the marketplace called moral hazard. Okay, and this is this concept that when companies get in trouble, maybe we shouldn't bail them out, because if you know that as a company that if I get in trouble, someone will just step along in and bail me out, it provides very little incentive to stay out of trouble, right? It's sort of like, you know, if you have kids, right? Like if you're constantly behind your kids cleaning up all their messes, they never learn not to be messy, right? Because there's no consequence to them for being messy. And in the great financial crisis, there was a lot of this talk going around, right? I mean, you remember there was a subprime mortgage crisis. The banks created these products. These products were awful. Now the banks are all, you know, crying, you know, in pain. And, you know, there's a lot of people out there saying, like, maybe we should just let them fail, right? Like, you know, why do we need to reward these people for what was seen as and was bad behavior, right? And not reward. Reward is the wrong word, but why should we save these people when they created this mess themselves? And the problem with that is there's two tensions with it. The first tension is, okay, yeah, I admit it. Like maybe you should be allowed to fail if you screwed up, right? And there should be harsh punishments for the people that you know that did these things. But the other problem with it is that banks and all financial institutions are very, very prone to runs, right? So everybody remember, what is it? It's a Wonderful Life. Everybody remember that movie, right? No, you've never seen It's a Wonderful Life? No. Oh, you're killing me. So George Bailey, he's in the savings and loan, and everybody wants their money taken out of the savings and loan. And George is like, look, that's not the way a bank works. Like your money was used as the mortgage to buy that guy's house. And, you know, your money was used as the down payment on this guy's car. And like, if you all want your money at once, like we don't have a bank anymore, right? Like we're fundamentally insolvent if everybody wants their deposits back all at the same time. And the U.S. banking system is exactly the same way, right? Like whether it's you and I trying to withdraw our savings accounts or large companies drawing down on their lines of credit or, you know, people just withdrawing cash from the system and saying like, yeah, like sell my bonds. Like I don't want these things anymore. The system is prone to runs. And so when Lehman failed, it made everybody else weaker. When Bear failed, it made everybody else weaker. And when the Treasury Department wandered around to the CEOs of the remaining banks and said, hi, there's this program, it's called the Tarp, participation was not optional in that program. That's what a lot of people don't realize, but like I've spoken to these CEOs. Participation was not optional. And the reason why is if the American public had known which banks were most at risk, which banks needed the help, then those banks would have failed immediately because it would have been an indicator to the American public that that was the bank or those were the banks that were insolvent and these were the banks, these over here that didn't need the money weren't. So it wasn't an option. Like Goldman Sachs was like, no, I'm not sure we need this. And the Treasury Department was like, oh no, you're taking it and I don't care. Right? Period. Full stop. So that to me was terrifying because once that run on the bank starts, there's literally nothing you can do to stop it. It's almost like, and I don't know where you guys are, if you go to your local grocery store, you know, they told us that there would be a shortage on toilet paper, and there's a shortage on toilet paper. And it's not because you haven't been able to buy toilet paper. It's not because all of the toilet paper factories are shut down. It's because every person in the country has all of a sudden decided that they need 50 rolls of toilet paper tucked away in their closet just in case, right? And they did the same stupid thing with the meat supply in the country, right? So I don't know if you've been following the headlines, but they're like, oh yeah, like it looks like there might be a meat shortage. The minute that they said that, I walked down to my grocery store, they're out of meat. They're out of meat. So in the same way, if you tell people, hey, Bank of America might be insolvent, immediately they're insolvent, right? Yeah. It's terrifying. I don't have any of those concerns around the current crash, largely because the question of moral hazard around the current crash is non-existent, right? This is nobody's fault. Nobody knew that the coronavirus was coming and could have protected themselves. It's not like Delta Airlines was, in a position to be like, oh yeah, like we're going to fly half the country around on a regular basis, but then one day everybody's going to stop flying. Like that is not something they could have predicted. It's not something they could have planned for. And so the willingness of the federal government to step in response to what is effectively a natural disaster and support the economy is almost unlimited, right? That's why you're seeing all these SBA loans. That's why you're seeing all of this aid to all these companies, because nobody's questioning whether or not the companies deserve it or not, right? In terms of how you thrive, look, I remember I was at Bain Capital, and it was like the day after Bear Stearns had failed, and we were all kind of just like, the market was in turmoil. We were all kind of under our desks, like, what are we going to do? Are we even going to have a job? Like, is our fund going to implode? And I remember our chief investment officer like called us all into a conference room at like, I don't know, 9:30 in the morning, and he was just like, look, like, everybody get your heads out from under your desks. Like, now is the time. Like, now, there are very few opportunities that you will have in your career to shine. Now is one of those times. Now is the time when you can deliver the most value to your clients. Now is the time when you deliver the most value on the investment side. Now is the time when when you separate the wheat from the chaff. Because anybody can look good in 2018, right? Anybody can look good in 2019. The people that look good in the early part of 2020 are superheroes, right? The people that are not out under their desks, they're out there, they're meeting with clients, they're walking them through, they're holding their hands, they're identifying opportunities, they're making the trades that they need to make. And like, now's the time, right? Now is the time, and I'm gonna finish this rant, but like, now is the time, now is why you pay your financial advisor, right? Like, you don't pay your financial advisor for 2018, right? Like, 2018 was a cakewalk. You pay your financial advisor for 2020, for being in that position, for holding your hand, for making sure that you don't make an emotional decision with your investment portfolio, for being there to rebalance, for being there to do all the work that you need to do when markets get this choppy. Like, now's the time when you earn your keep. And that's, we've heard Bobby and Shannon give that message over and over again to all of our advisors. It's what I tell our investment team every day. So, it's like, now's the time. Now's the time to shine.
Awesome. Thank you. We've got one question that came in from the web, and I'm going to shoot this at you, although I hesitate I almost want to just answer it off the cuff here, but should money from savings be brought into the market?
That's an interesting question. The question is, why was it in savings to begin with? And no, but I mean that. You're laughing, but I mean that. If this is savings because you were saving up to buy a new car and you plan to buy that new car in a month or whatever, then you should probably just buy the new car, right? If this is savings that is like, oh, like my daughter is getting married later this year and I've saved up all this money, but maybe I want to put it into the marketplace for a couple of months, the answer is no, don't put it in the marketplace for a couple of months. You've got that need, pretty quickly. If this is savings, which I literally had a client call me about today, where they had like literally $100,000 in like a coffee can in their kitchen. I don't know how that happens, but it does, right? I'm not making this up. And it's like, yeah, like we've been stashing this money away and I just haven't sent it to you yet, but we were looking at the marketplace and I was like, yeah, that money, like flow it on in, and we'll flow it on in a way that, we'll dollar cost average in. But if it was in savings for a particular purpose, I would say, nah, maybe not, because we're not out of the woods on this thing yet, right? Like, it would not surprise me. You asked me about tops and bottoms. Do I think it's inconceivable that we can retest 2,300 on the S&P 500? Absolutely not. I think it's entirely possible, right? Do I think it's entirely possible that we're at 3,300 by the end of the year? Yeah, it's possible. So you want to kind of dollar cost in as you average in to make sure that you're not buying at a particularly good or a particularly bad day. And if it's just spare cash laying around, then I'm always going to tell you there's never a bad time to invest. But if it's savings that you had tucked away for a particular near-term purpose, I would tell you that you should probably just leave that sitting on the sidelines for a while.
Perfect. Well said. That was the last question that I got from the web. And that was the last question that I had prepared from the clients that I talked to this week. Anything else that you'd like to mention for tonight?
I'm good. I hope everybody out there is staying happy and healthy. You know, we've got your finances under control here. So, you know, hopefully, if you're retired, you're finding something fun to do at home. And you know, hopefully you guys are staying, you know, staying busy or as busy as one can be. You know, I'm certainly encouraging every member of our team, you know, absent events like this, whether it's before market open or after the market closes, to just, you know, get out there and get active and stay healthy, and you know, just try and, you know, we're coming out of the woods eventually on this thing, but Lord knows, you know, just trying to maintain a little bit of physical activity and a little bit of mental, I won't say mental health is the wrong, self-care, I guess is the right word for it. But yeah, take the time because it's worth it.
Well, thank you so much. Always a pleasure, and have a great night.
Great. Thanks, guys.